The recent surge in trading activity around automotive stocks has highlighted key players such as Tesla, NVIDIA, Micron Technology, and Taiwan's semiconductor manufacturing. These companies, integral to the automotive and technology sectors, have been under scrutiny due to their significant trading volumes and market movements. Tesla, a leader in electric vehicles, saw its stock decline by $30.51 to $302.05, despite maintaining a substantial market capitalization of $972.90 billion. This drop comes amid broader fluctuations in the automotive sector, which is influenced by consumer demand, regulatory changes, and technological advancements. Tesla's financial metrics, including a high price-to-earnings ratio of 165.87, reflect its growth potential but also underline the volatility associated with its stock. NVIDIA, known for its graphics and computing solutions, has also been a focal point, with shares increasing by $2.13 to $172.91. The company's foray into automotive platforms and metaverse applications positions it strategically for future growth, supported by a robust market capitalization of $4.22 trillion. Meanwhile, Micron Technology's stock rose by $2.05 to $111.88, reflecting investor confidence in its memory and storage solutions critical to the automotive industry. Taiwan's semiconductor manufacturing, a key supplier in the semiconductor space, experienced a slight dip, trading down 3 cents to $240.30, yet remains a vital component in the global supply chain. These movements underscore the dynamic interplay between technological innovation and market sentiment, offering potential opportunities and risks for investors navigating the automotive and tech sectors.
Intel Corporation, Nasdaq, INTC, has reported its Q2 2025 financial results, exceeding revenue expectations with a total of $12.86 billion, surpassing the forecasted $11.92 billion. Despite this revenue beat, the company faced a net loss of $2.9 billion, highlighting ongoing challenges in its foundry business, which reported a $3.17 billion loss. Under the leadership of new CEO Lip-Bu Tan, Intel is undergoing significant restructuring, including laying off 15% of its workforce and halting planned factory expansions in Germany and Poland, while slowing down its Ohio project. These strategic shifts aim to enhance competitiveness and optimize capital allocation. Intel's performance in its core business areas showed mixed results, with a slight decline in PC chip sales but a 4% increase in data center revenue. Looking ahead, the company projects a Q3 revenue of $13.1 billion, targeting a break-even point as it seeks to regain market share. Intel's strategic focus remains on adapting to market demands and securing key customers, particularly for its Ohio facility. While Intel is recognized as one of the best ethical companies to invest in for 2025, some analysts suggest that AI stocks may offer higher returns and lower risks, reflecting broader market trends favoring AI advancements.
The U.S. stock market is poised for a potentially volatile week as investors brace for several significant events. The S&P 500 and Nasdaq Composite have experienced remarkable gains of 28% and 38%, respectively, since their yearly lows, but the market's calm could be disrupted by a series of upcoming developments. Key among these is the August 1st deadline for increased tariffs on various trading partners, set by President Donald Trump. This deadline, if not addressed through trade deals, could introduce volatility, especially given the market's recent highs following a recovery from April's tariff-induced slump. Adding to the market's uncertainty are the earnings reports from major tech companies, including Apple, Microsoft, Amazon, and Meta platforms, which are expected to influence market sentiment due to their substantial market capitalizations. As of now, second quarter earnings for S&P 500 companies are on track for a 7.7% increase year-over-year, surpassing earlier estimates. However, with the S&P 500's price-to-earnings ratio at 22.6, significantly above the historical average, there is concern that any negative surprises could prompt a market correction. Investors will also closely monitor the Federal Reserve's monetary policy meeting and the U.S. employment report, which could further sway market dynamics in the coming days.
Japan has announced a significant $550 billion investment package as part of a new trade deal with the United States, potentially benefiting Taiwanese semiconductor firms planning to build plants in the U.S. This initiative, confirmed by Japan's chief trade negotiator Ryosei Akazawa, aims to secure lower tariffs for Japanese exports while bolstering critical supply chains in sectors like semiconductors. The investment will be facilitated through Japan's financial institutions, such as the Japan Bank for International Cooperation, JBIC, and Nippon Export and Investment Insurance, NEXI, focusing primarily on loans and guarantees rather than equity investments. The strategic move comes amid growing concerns over economic security due to the U.S.'s reliance on Taiwan Semiconductor Manufacturing Company, TSMC, for advanced chip production, especially given Taiwan's proximity to China. TSMC has already committed to a substantial investment in the U.S., including $100 billion announced, alongside former President Trump, with existing operations in Arizona. This collaboration not only aims to strengthen the semiconductor supply chain, but also highlights Japan's proactive role in securing economic interests while mitigating tariff costs, potentially saving around $67.72 billion. The initiative underscores a broader geopolitical strategy to diversify and secure tech supply chains amid global tensions.
European smaller companies are increasingly attracting investor interest as a strategic hedge against the dual pressures of potential tariff impacts and a strengthening euro. This shift is largely driven by the domestic focus of these companies, which makes them less susceptible to trade levies and currency fluctuations that affect Eurozone exports. The Stoxx Europe small and mid-cap indexes have outperformed their large-cap counterparts, with gains of 9% and 11% respectively this year, compared to a 7% rise in the large-cap index. This trend is supported by cheaper credit and anticipated government spending, boosting economic confidence. The ongoing trade tensions, particularly between the U.S. and the European Union, have heightened the appeal of these smaller, domestically oriented firms. Despite U.S. President Donald Trump's recent trade agreements, uncertainty remains with the EU as an August 1 deadline looms without a deal. Analysts note that the stronger euro, which has risen over 12% this year and is expected to reach $1.20, poses a challenge for larger, internationally exposed companies, while small and mid-caps benefit from their relative insulation. The valuation gap between small and large companies has been narrowing, with small caps trading at a 6.5% discount to large caps at 13.4 times forward earnings, reflecting growing investor confidence in their earnings potential.
India is poised to become a major driver of global economic growth, with Morgan Stanley forecasting the country to contribute 20% of total global growth by 2035. The report highlights India's trajectory to becoming the world's third largest economy by 2028, with its GDP expected to double to $10.6 trillion by 2035. This growth is underpinned by a combination of decentralized state-level growth, strong domestic demand, and structural policy reforms. Key states like Maharashtra, Tamil Nadu, and Gujarat are emerging as economic powerhouses, with some expected to achieve $1 trillion economies. This reflects the success of India's competitive federalism, which encourages states to innovate in policy, industrialization, and urbanization. India's manufacturing sector is gaining momentum as multinationals seek alternatives to China, bolstered by the government's production-linked incentive (PLI) schemes. These initiatives are fostering increased exports, industrial capacity utilization, and global partnerships in sectors such as electronics and renewable energy. Additionally, India's capital markets have outperformed most emerging markets, driven by resilient corporate earnings and robust foreign portfolio investments. The Asian Development Bank, ADB, projects India's GDP growth to remain strong at 6.5% in 2025 and 6.7% in 2026, with inflation moderating within the Reserve Bank of India's target range. This positions India as a standout performer in a region facing economic uncertainties and geopolitical tensions.
Eli Lilly and Company, NYSE LLY, has recently received bullish ratings from both Leerink Partners and Jefferies, signaling strong analyst confidence in the pharmaceutical giant's growth prospects. Leerink Partners maintained its buy rating, emphasizing the potential of Eli Lilly's GLP-1 receptor agonist, GLP-1RA medications, such as tirzepatide, which have shown promising results in improving blood sugar control and reducing risks of dementia, stroke, and death in patients with type 2 diabetes and obesity. This development could enhance Eli Lilly's standing in the neurology sector, particularly if upcoming Alzheimer's trial results from competitor Novo Nordisk prove favorable. Jefferies also upheld a buy rating on Eli Lilly, setting a price target of $1,057, compared to its current trading value of $805.43. Eli Lilly's strategic positioning in the incretin and Alzheimer's markets underscores its potential for significant future growth. The company's focus on ethical business practices further solidifies its reputation as a robust ESG investment. While Eli Lilly's prospects are promising, the report suggests that certain AI stocks might offer higher returns, indicating a competitive landscape for investors seeking substantial upside potential in diverse sectors.
The fintech sector is currently attracting significant investor interest, with several companies standing out due to their potential for growth and disruption in traditional banking. Key stocks highlighted include Mercado Libre, Rocket Companies, Carlyle Group, and WEX, each leveraging technology to provide innovative financial services. These companies are drawing attention due to their recent trading volumes and market activities. Mercado Libre, a major player in e-commerce and digital payments in Latin America, saw its stock price decrease by $29.68 to $2,361.38, with a trading volume below its average. Despite this dip, the company maintains a robust market capitalization of $119.72 billion and a P/E ratio of 58.08, reflecting strong market positioning and growth potential. However, its high beta of 1.49 indicates potential volatility. Rocket Companies, known for its fintech solutions in the mortgage and lending sectors, experienced a slight increase in its stock price to $14.90. The company has a substantial market cap of $29.79 billion, but faces earnings challenges, as indicated by its negative P/E ratio. Its high beta of 2.28 suggests significant volatility, appealing to risk-tolerant investors. The Carlyle Group, a global investment firm, saw its stock price rise to $63.48, supported by a market cap of $22.93 billion and a P/E ratio of 21.54. This reflects investor confidence in its diverse investment strategies, including leveraged buyouts and venture financing. WEX Inc., which provides fleet payment solutions and transaction processing, traded up to $176.17, with a market cap of $6.03 billion and a P/E ratio of 22.28. WEX demonstrates steady growth and appeal within the fintech space. While these fintech stocks present opportunities for growth driven by technological advancements, they also come with risks such as regulatory changes, cybersecurity threats, and competition. Investors are advised to consider these factors carefully when evaluating potential investments in this dynamic sector.
The latest stock performance analysis highlights Invesco QQQ, Fiserv, and Bank of America as significant entities to monitor in the banking sector. Invesco QQQ, a unit investment trust, aims to mirror the Nasdaq 100 index's performance and has shown a slight increase, trading at $564.83, close to its 12-month high of $566.06. Despite a lower trading volume than average, the trust's stock continues to perform strongly, with its 50-day and 200-day moving averages indicating a steady upward trend. Fiserv, a global provider of financial services technology, experienced a decline in its stock value, trading down to $139.77. This drop is notable given its previous high of $238.59 within the year. The company's financial ratios, such as a quick ratio of 1.10 and a debt-to-equity ratio of 1.02, suggest a stable liquidity position, though the decrease in stock price may reflect broader market volatility or sector-specific challenges. Bank of America, one of the largest financial institutions globally, saw its stock rise to $48.94, nearing its 12-month peak. The bank's performance is underpinned by a robust market capitalization of $368.57 billion and a P/E ratio of 14.32, indicating potential investor confidence. The trading volume remains substantial, although below average, suggesting sustained interest amid broader economic conditions. These movements in bank stocks underscore the sector's sensitivity to interest rate changes and economic indicators, which continue to shape investor sentiment and market dynamics.
Micron Technology, Inc., NASDAQ, MU, has announced the launch of its latest innovation, the industry's highest-density radiation-tolerant SLC NAND flash memory, geared towards the growing demands of the space economy. This new memory chip is engineered to withstand the harsh conditions of space, including radiation and extreme temperatures, making it a prime candidate for advanced space missions. Micron's technology has already been utilized in NASA's EMIT spectrometer mission, and the company aims to further penetrate the aerospace sector by supporting AI-driven, autonomous spacecraft with robust data storage solutions. Micron, the only major U.S.-based memory manufacturer, continues to solidify its position in the market with its advanced DRAM, NAND, and NOR solutions under the Micron and Crucial brands. The company's inclusion on Ethisphere's 2025 list of the world's most ethical companies highlights its commitment to ethical business practices, attracting significant interest from hedge funds. Despite its promising growth trajectory in the aerospace sector, some analysts suggest that AI stocks may offer higher returns with potentially lower downside risks. Nonetheless, Micron's strategic expansion into space technology underscores its adaptability and innovation in a rapidly evolving market landscape.